Hello, I'm Hickey from interest.co.nz and welcome to our weekly currencies report here with Dan Bell from HiFX. Never a dull moment, we call it, and there have been a few more dull moments this week than last week, but compared to normal, it's certainly not normal. Dan, how was this week for the Kiwi at least?
Well, the week started off a little bit more calmer than last week, and we all know how volatile it was last week. But overnight we've seen more carnage come back to financial markets. We saw the European stock markets have their biggest drop in 2.5 years. That flowed through to the US equity markets, which again down around 4%, which is again another huge drop. New Zealand dollar, being a risk-on currency, was under pressure as everyone was taking risk off the table essentially, and we've dropped from up around 84 cents yesterday down to around a low of 81.70 or so this morning.
Let's look in a bit more depth at the core of the problem, which is in the European money markets, those interbank markets. What have we seen over the last day or two to say there is a bit of stress there?
Yeah, so the key announcement in the last 24 hours was a report that the ECB, the European Central Bank, had to lend a European bank $500 million in 1 week funding. So effectively, the bank, which hasn't been named, and I did actually ask around the market and try and find out who it was, had to actually go to the ECB as a lender of last resort because no other banks were willing to provide that short-term liquidity for their normal operations.
So just to explain, banks every night will tot up how much money they've got, and they often have to go into the markets to get what they need to settle up their accounts. And often they go to other banks to do that, the interbank market. Absolutely. And last night, one of the banks went into the market and the other bank said, no. Yeah. And so that bank had to go to the central bank to say, okay, no one's dealing with us right now, can you give us the money? Which is obviously a bad sign.
Yeah, it is a bad sign, and I think it gets everyone a lot more suspicious about the whole issue that we're facing, and takes everyone back to to the subprime disaster back in 2008, where everyone there was a breakdown in trust between the banks, and the short-term money markets all froze up, and that had a huge impact on the global economy, as we all know. So suddenly everyone's thinking that the sovereign debt crisis and the European debt issues and the potential contagion into the US market is getting heightened every day.
On the European side, one of the things that seems to have triggered it again was this failure of the big summit between Sarkozy and Merkel. We call it Mercosur, like Angelina and Brad, Brangelina. Yeah. Mercosur. That summit didn't come up with the Eurozone bonds that everyone was hoping for.
Yeah, so they were catching up to try and come out with some kind of additional solution to the European sovereign and banking crisis, and some had been hoping that they were going to announce some type of European bond, which would be another step closer to the European Union, creating fiscal unity as well as monetary unity, and they didn't. So that disappointed the markets, and so clearly there is not enough cooperation or at least common ground in the Euro region between the political leaders to come to the market with a solution that's going to hopefully get us through this crisis.
And that seems to be a theme in this crisis at the moment, a lack of confidence in the political leadership, not just in Europe but in the United States too.
Yep, absolutely. Yeah, absolutely. And I think if you go back to the beginning of August, when the whole US debt ceiling was being debated, and then the S&P, Standard & Poor's, downgrading the US, I think the Standard & Poor's actually mentioned that the lack of political will was one of the deciding factors in them downgrading the US. And I think certainly what we're seeing in Europe and continuing to see in the US, it doesn't seem to be political leadership or even leadership from the policymakers that is coming out with anything that is meaningful enough to stem this crisis.
And looking at how that's affecting things on the ground, we saw numbers from the Philly Fed overnight about what factories were doing in that week when the debt ceiling debate was on, and it wasn't good.
No, exactly. The Philly Fed index, survey is a survey taken from manufacturers in the Midwest of the US, and it's closely watched by analysts around the world. That came out at a 2.5-year low, so the lowest it's been since March 2009. So similar kind of levels that we had at the, effectively at some of the worst levels in the GFC. However, the survey was taken in the first week of August when that debt ceiling was the focus of everyone's attention. So I'd ask the question that perhaps if you were being asked, what your intentions were in terms of purchasing and whatnot in that week, it would have been pretty negative. So this whole period, I think, is recessions can become self-fulfilling prophecies, and I suppose the concern is that the lack of sort of political will and the lack of policy developments over the last few months have deteriorated economic and investor sentiment, and that's being reflected in this volatility and general uncertainty that we're seeing around the world.
And one of the factors underpinning this lack of confidence is the realisation that in many cases central banks and the governments have used their ammunition up. Particularly, we're looking at the US Federal Reserve and whether it does a third round of quantitative easing. Mm-hmm. Some talk this week that maybe it can't or won't.
Yeah, well, that's right. I suppose the whole idea of QE3 has been debated. The Fed, to this point, have been quite guarded about the concept of what a QE3 might actually even look like. Perhaps they're questioning how successful QE2 was. So it will be interesting, particularly with Jackson Hole, the central bank meetings coming up next weekend. And it was this time last year that the Fed chairman, Ben Bernanke, came out after that Jackson Hole symposium with the announcement of QE2. So that's going to be quite important over the next week or so. So
this time next week, the central bankers will be getting together with their ties off in the warmth of Wyoming and talking about monetary policy.
Pretty much, yeah.
Sounds like a fun time, actually. But we'll all be watching as well.
We will, yeah.
Now, coming back closer to home, Australia and New Zealand, in the last week, there have been not too much in the line of economic developments, but some talk from the Reserve Bank of Australia and a few bits and pieces over here. What's the story here in this part of the world?
In this part of the world, it's a little bit of business as usual. Things in Australia. I mean, the Reserve Bank of Australia's minutes didn't really give too much away. I think it's going to be a wait and see game with the Reserve Bank over there. Their interest rates are still set at around 4.75%. So really, if you look around the world, Australia's got a lot of room to drop interest rates if things actually get worse. So again, if you step back from that and think, well, maybe if they do have to cut interest rates, they've got a bit of room to do so. Likewise in New Zealand, I suppose our interest rate settings at 2.5%. Certainly, the pricing for any interest rate hikes as early as September has been thrown out. And certainly the wholesale, swap rates and the yields on those swap rates continue to push lower as the offshore developments continue. And it's interesting to note actually that the US 10-year Treasury yield dropped below 2% briefly overnight, which was the first time since 1952 or 1953.
Isn't that extraordinary? Investors are willing to lock their money up in a security that's just been downgraded, only get back less than 2% when they know inflation is at least that, if not more, and
Correct.
Possibly higher over the next 10 years.
Yep, for 10 years, which as you point out, is quite amazing. And I think that really reflects the level of anxiety and uncertainty in investors' minds at the moment. If you're willing to pay, receive, effectively 2% for 10 years per annum, as you say, in a government security that's just been downgraded, you must be pretty worried about the outlook.
Now, just looking ahead the next week or two, the big focus of the markets, currencies, what will that be?
Well, it's all about what happens with these European debt markets, whether or not we see further issues there. Obviously watching to see if there's any announcements from the ECB and the Fed. Data-wise, I mean, economic data for the moment in New Zealand, we've got retail sales numbers next week, which will be of interest for the second quarter. But for the time being, it's really about the offshore developments and what happens in these wholesale money markets in Europe and the US.
There we have it. Dan Bell from HiFX with Never a Dull Moment, our weekly currencies report. The theme for the next week will be interbank markets, Jackson Hole. I'm Bernard Hickey for interest.co.nz.